Good evening, everyone. You're welcome
You're
again
welcome
to
again to
another class on financial reporting. I know and I can confirm that you can hear me very clearly. I hope you have had a wonderful day today. And I can see and I know from your timetable that you have been very free since morning. You've been very, very free since morning. And I hope you have judiciously utilized those free periods to do my assignments, to revise the other courses you're having. I mean, those open period are supposed to be used in that manner. It will help you. I think I'm back. So for tonight, we'll be looking at a very important standard or another important standard because every one of it is equally important, which is financial instrument. I remember vividly that yesterday night we handled intangible assets on IS 38. And you would see that there is a serious similarity between intangible assets and between intangible assets and PPE in terms of their recognition and measurement. Both intangible assets and PPE, they have similar recognition criteria, which says that before you can recognize them, it must be probable that future economic benefit associated with the item will flow to the entity, and it must have a cause that can be measured reliably. Also, their measurement basis in terms of initial cost and subsequent measurement. However, for intangible asset, when you're measuring it initially, you need to carefully look at which intangible asset we are talking about. If it is a purchased intangible asset, then those can be measured at cost. But if it is an internally generated intangible asset, those are not recognized in the books because we cannot reliably measure their cost and benefit. Because of that, internally generated intangible assets like goodwill, like brand name, like trade secret, like customer lists, we can't determine how much you spend in creating them. You might not even be able to attach money to how much you're expecting to make from them. You can't measure them reliably. For that reason, we say that we don't recognize them in the books at all. But I told you that in the consolidated financial statements, these internally generated intangible assets can be recognized and measured because in a consolidation arrangement, the parent will have paid for them. The parent will have actually paid for the goodwill. He would have paid for the customer list. He would have paid for the trade secret. He would have paid for the brand name. For that reason, the amount the parent paid can be said to be their cost. So we can measure them in those arrangements. But in individual financial statements, they are not recognized in the books. They are not. Though there are controversy around those areas, but I mean, is not what I want to go into discussion with you guys. Furthermore, I mentioned that for intangible assets, when you're looking at intangible assets that are internally generated, there are some that are regarded as research and development, where they are internally generated, but those ones you can trace it to a project in such a way that you can accumulate their cost. And we said that the cost you incur at the research phase, you expense that to P&L, But the costs you incur at the development phase, you capitalize them if they meet 6 criteria, which I shorten as pirate for you to memorize it for exam. So that means that before you can capitalize a development cost, it must meet those 6 criteria. Number one is probable inflow of economic benefits. Number two is intention to complete and use the asset. Number three is that resources are available to complete the asset and there is ability to actually use and sell it. And also it is technologically feasible to complete and the expenses can be identified by rate. And I said that summarily, to know whether these 6 criteria are met, look out for board approval and regulatory approval. As soon as there is board approval for a project or there is regulatory approval for a project, then any cost you incur afterwards are capitalized. And we saw an example, if you remember, where a taxi company is trying to get license from the government. They incurred so much money, like around 700,000 in applying for that license. But when they were paying that 700, they were uncertain as to whether they will get that project or not. They were uncertain. For that reason, we expensed that 700. And from the day they were certain that they will get approval, and from the day they got regulatory approval, which is November, subsequently they incurred 90,000. And it was that 90,000 alone that we capitalized. And that's how it works. So you need to understand that and appreciate that. There are a lot of questions like that. The one I solved for is actually a past question they have asked way back. So I think I've shared the collated past question from 2014 to 2024 November. If I haven't shared, I'll forward it to you. You need to solve all questions on topics we have solved so far on those. It's extremely important that you do that. Extremely important. So we solved some questions and a lot of details. The videos is available for you on YouTube to watch. The working notes is available for you. Practice, 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 and you'll be fine. Okay, tonight we're going to be looking at financial instruments. When we say financial instruments, narrow your mind down to two things. Two things. Number one is debt instruments. Number two is equity instruments. So everything I want to teach you in this topic revolves around these two: debt instruments and equity instruments. When we say debt instruments, it means debts. I mean, if I even leave the instrument alone, maybe that is sounding too technical. When I say debts, debt is borrowing money. Debt is borrowing money. When you borrow money, you have a debt. But technically, the action of borrowing money in the business world is not, it doesn't happen orally. It doesn't happen very casually. It's an highly documented process and an highly formal process because money is involved. So usually there would be a contract, there will be a paper where both parties will agree. And that's what we call debt instruments. Those are the instruments. So if you want to borrow money, is either you're using loan notes. Loan notes is a debt instrument. So if you want to borrow money from the bank, you are going to issue loan notes. Loan note is just an agreement, believe me. It details all the terms and conditions around the borrowing. Or Treasury bills. This is popularly used by governments to borrow money. Another one that is very popular right now because of the high interest rate environment that we found ourselves right now is commercial papers. These are usually listed on FMDQ. Corporate organizations use it to borrow money instead of going to the bank. They use this one to borrow money from the public. There is bonds, both corporate bonds and government bonds. There's corporate bonds, similar to commercial paper. There's government bond, both state and federal government bond. They all issue bonds to borrow money. See, all these are instruments that are used to borrow money. For equity instruments, equity is share capital. And this is also used to raise money from shareholders. This is used to raise money from shareholders. So typically, you will be having instruments like ordinary share capital. You can have preference share capital. These are the popular ones you would find in your exams. Ordinary share capital and preference share capital. Now, our mission for today is for me to teach you how to account for both these debt instruments and the equity instrument. By the end of this topic, you should be able to conveniently account for them. How do we achieve this? We are going to be using two standards to teach you how to account for debt instruments and equity instruments. Number one, I'll be using IS 32. It's a standard called Financial Instruments Presentation. I would also be using IFRS 9, which is a standard called Financial Instruments Recognition and Measurements. I'll be using these two standards to teach you how to account for debt instrument and equity instrument. I'll be starting with IAS 32 that speaks to financial instruments presentation. And this standard, basically, I'll teach you three things under the standards. Number one is definition of terms that you need to understand. Number two, you'll be looking at classification and presentation of financial instruments into debt instruments and equity instruments. Also, I'll be using this standard to teach you compound financial instruments. So let's start with this. First, the definitions that you need to know. There are three definitions or four. First, I will define financial instruments, though I've told you that it's all about debt and equity, but you need to know some definitions. Secondly, we will define financial assets. Thirdly, we will define financial liabilities. Fourthly, we will look at equity instruments. So let's pick them one by one. Financial instruments. IS 32 says that Financial instruments is any contract that gives rise to financial assets of one entity and financial liability or equity instruments of another entity. This is the definition given by IS 32. It said financial instrument is any contract that gives rise to financial assets of one entity and financial liability or equity instruments of another entity. The first thing here that will captivate or that should captivate your attention is contracts. It says financial instrument is any contract. So before you can talk about financial instruments, you need to clearly understand that it is any contract. There has to be a contract. And a contract is an agreement between two parties that has legal and economic consequences. An agreement between two parties that has legal and economic consequences. This goes to show that what makes an agreement a contract is that there is legal and economic consequence. In the sense that if a party does not exercise or perform as expected, that party will face legal consequence or economic consequence. He will be penalized. He might be charged to court. He might be required to face some consequences, whatever it may be. That goes to show that a contract, therefore, need not be in writing. It doesn't have to be in writing. It could be any way, any customary way that agreements are made in that environment. What is important is that there are legal and economic consequences to violations of those agreements. That's what makes it a contract. So before you can have a financial instrument, there has to be a contract in existence. Now, this contract must give rise to financial assets of one entity and financial liability or equity instrument of another entity. This clearly shows that before you can say we have a financial instrument arrangement, there must be at least two parties. Two parties must exist. One party must have a financial asset, and another party would have either a financial liability or equity instrument. That is, if you have party A and you have party B, whoever this person is, party A, there must be a party A that would have a financial asset. And there must be a party B that would have financial liability or equity instrument. That's the way it works. So you need to get used to this arrangement. One party must surely have financial assets. Another party will now have either financial liability or equity. And that's what this second part of this standard will teach you, which I will teach you today. It's part of what I want to teach you today. So basically, it's these two that I want to achieve today. As soon as I achieve that, you guys are free to go. Even if it is 11 o'clock, I'm able to achieve that. Okay, as I was saying, the other party must have either of these two. And it's very easy to identify that. If I go back to the examples I gave you. Let's take debt instrument, for example. And I gave you an example of a loan note. If you borrow money from the bank, it doesn't happen orally. It's an highly documented process. So let's say you issue a loan note, which is basically an agreement, and all the parties agreed. You see, that arrangement is a financial instrument arrangement because there is a party that has a financial asset, which is the bank that gave you money. We see them as an investor. And there is another party, in this case, has a financial liability, which is you, that you are borrowing money. And the same analogy can apply to treasury bills, commercial papers, and all of these debt instruments. But from the standpoint of an ordinary share capital, which is an equity instrument, when you issue ordinary shares, it means that the counterparty that buy your shares, who is an investor, that counterparty has a financial asset. While you, the issuer, you that you're going to collect money, in that case, you are going to have an equity instrument, not a liability in this case, because what you have issued is a share capital, is an equity instrument. So in this case, you would have equity instruments. It's important you're able to identify these two. Going forward, what is then a financial asset? A financial asset is any contract that is cash, contractual right, sorry, and before then, equity instruments of another entity, and contractual rights to receive cash or to exchange financial assets with another entity under conditions that are potentially favorable to the entity. Okay, so financial assets is cash. When you have cash, that is a financial asset. And what is cash? Cash is cash. The money you have in your bank, the money you have at hand, cash is cash. There is no special definition for it. I mean, as far as understanding is concerned, when you have cash, you have a financial asset. You classify it as a financial asset. Secondly, financial asset is also equity instrument of another entity. And this simply means that buying shares in another entity. So if you buy shares of any company, you will have a financial asset. When you buy shares in another entity, you automatically have a financial asset. Thirdly, it says contractual rights to receive cash. In fact, you see the standard also says or another financial asset. but I don't always want to bring up that. I always want you to understand this first. Contractual right to receive cash. And when you have contractual right to receive cash, it means that you have borrowed or you have lent money to a counterparty. Let me call the other party a counterparty. When you lend money to a counterparty or to a person, it's a financial asset to you because you have right to receive cash. You have right to receive interest. You have right to receive principal. And it's not just any right, but a contractual right. In the sense that the person or the counterparty must pay you. If he doesn't pay you, if he doesn't give you that money, there will be legal consequences. There will be economic consequences. I mean, you seriously need to understand that contractual right to receive cash means that you don't have to struggle to receive that cash because there's a contract behind it. And there's usually a specified date where you have to receive that money. And if the person does not get you that money at that specified date, there will be legal consequence. There will be economic consequence. And you need to understand that when you have items like inventory, you have goods that you want to sell, don't confuse that as having financial or a contractual right to receive cash. Inventory does not give you right to receive cash. Inventory only gives you an opportunity to generate cash. You have to make a lot of efforts to sell that inventory. You need to put in a lot of marketing structures to sell that inventory. If you don't put in all of those, you will not sell. So where is the right to receive cash? So inventory does not give rise to right to receive cash. So inventory is not a financial asset. So also I taught you IS 16 PPE, I taught you IS 38 intangible assets. All these are clearly not financial assets because they don't give rise to right to receive cash. They only give you an opportunity to generate cash if you use them judiciously. If you buy an equipment or you have a license and you dump it and you're not using it, you will not make money. And there's nobody that you can sue for not making money. But when you say something is a financial asset, it gives you right to receive cash or right to receive another financial asset, maybe equity. Equity is another financial asset. So when you're talking about right to receive cash, it means you have lent money to somebody. So when you, I mean, when you invest in government T-bills or you invest in commercial papers, that gives you right to receive cash. Another one that can give you right to receive cash is when you sell on credit. When you sell on credit, it gives you right to receive cash because what you'll be expecting is money. You would have a trade receivables. You have a trade receivables, and that trade receivables is a contractual right to receive cash. And it's compulsory that the person gives you the cash. Otherwise, there will be legal consequence. There will be economic consequences. Another one is financial liability. And this is a contractual obligation to deliver cash or another financial assets, or to exchange financial assets with another entity under conditions that are potentially unfavorable to the entity. Again, financial liability is a contractual obligation to deliver cash, in the sense that is a contractual obligation to deliver cash that if you don't pay that cash as and when due, you might be in trouble. You might be in trouble. You have to deliver the cash. And typically, this will arise when you borrow money or when you purchase goods on credit. These are contractual obligation to deliver cash. You will see that I'm intentionally leaving out this for now, even here, this exchange. I'm just putting it here because they can ask you to define this. So you need to, but in application for now, this issue of exchange, you might not really go deep into it for now. Finally, is equity instruments. For those of you that are in class, I've been talking for the past, how many minutes now? Like past 30 minutes? For those of you that have been in my class, is there anybody here that can tell me the definition of equity instrument in line with the conceptual framework? I guess I've taught you that. Is anyone here that can remember that definition?
Yeah, good evening.
Yeah, go ahead, please.
According to what you said they are instruments used to borrow money from shareholders.
You're not borrowing money from shareholders. So you want to raise money from shareholders.
Okay. Are they
Yeah,
not the same?
I know it's not the same.
Borrow,
Borrow
raise.
and raising. That borrow, it means
Yes.
you will pay back the money. But when you're
Okay.
raising money, right? If you are not
Yeah.
using borrowing, you will not pay back the money. The
Okay.
person has given you the money for life.
Okay.
The person will only get dividend.
Okay. Okay. Okay.
Yes, I actually mentioned that. But what I want is there's a definition I gave when I taught you conceptual framework. When I was teaching elements of financial statement, I taught you about definitions of those elements. And I taught you definition of equity. And I told you that equity is a residual interest in the assets of an entity after deducting all liabilities. So that was the definition I gave you there, and we explained this very well. Okay, so I'm done with this definition and explanation. You're supposed to know these definitions according to your exam. It's important. So let's apply this definition which is this second part. Let's apply this definition. Then I'll use examples to see how we can classify financial instruments into debt and equity, especially for the issuer. I will use a past question to resolve this. Then I will give you an assignment. Then I would stop there for today to go and practice with that assignment. So let's go to this question to practice that. I really want every one of you to participate in this question because this is a very important part. Your examiner find this extremely. I will still come back to this one, so let me move it down. Okay, let's tackle this question first. Is Femi here?
Yes, sir. Good evening, sir.
Hi Femi, how are you doing today?
I'm good, thank you.
Okay, let's read this question.
Okay. The following relates to network play sale for the year ended 31st December 2021. A. Network owns cash of 5,000 naira. B. Network owns a demand deposit of 1 million naira with First Bank. C. Network statement of financial position include 2.5 shares of Google Incorporation. Then D. Network statement of financial position include inventory of 56,000. E. Network sold goods amounting to 55,000 to Layi Limited on credit. F. On December 2021, Network received an advance payment of 250,000 from one of its customer, Muri Limited, to deliver goods in January 2022. G. Network statement of financial position includes a current tax liability of 5,000 naira as well as a deferred tax liability of 6,500 naira. H. Network purchased a Bitcoin of 5.5, that's 5,500,000. You are then required to determine whether the item above are financial asset or financial liability, as also state whether a financial instrument exists as at 31st December 2021.
Thank you very much, Femi. So looking at this question, I want anybody can just talk randomly. You're going to pick it one by one, then answer. Then I will also make corrections. Then we discuss it. We just discuss. Then this will be your like first assignment. Whatever we discuss, I would expect every one of you to write it down and send it to me. When you send it to me, I will then send you the solution. I guess some of you that have sent me or shared your solution on IS 16. I'm sure I have shared you the solution. If you have solved those questions I give you as assignment on IAS 16 PP and I've not sent you the solution, please, you need to request them so that you can use it for further practice. I'm still waiting for the remaining students to share theirs, and I'll advise you to do that as soon as possible. Okay, if you look at the requirement of this question, it wants us to do two things. Number one, you say we should determine whether the item above are financial asset or financial liabilities. So that's the first thing you need to determine. Is it a financial asset or a financial liability? I think they missed or equity instrument. Let's just leave that for now. And also, after you have ascertained that, you also need to state whether a financial instrument exists as at 31st December 2021. So two things we need to do. So you will need to tell us whether this company has either financial assets, financial liability, or equity. Also, you need to tell us whether financial instruments exist. Okay. So who is going to pick the first one? Who is going to go first?
Latif.
Oh, okay.
Okay. Go ahead, Latif, please.
Net worth owns cash of 5,000 naira. So net worth has a financial asset.
Okay.
There is no financial liability, and there is contract do not exist.
So this is not a financial instrument contract. Is that what you're saying?
Yes, sir.
Okay, that's absolutely correct. That's absolutely correct. So net worth owns cash. That means net worth has a financial asset. Cash is a financial asset. And because there is no other party that we can say has a financial liability or equity, so because of that, we don't have that two-party relationship. And you know that before we can have a financial instrument, there must be at least two parties. So because there is no another party, we don't have another party, for that reason, having cash does not give rise to a financial instrument arrangement. So financial instrument does not exist. Network does just have cash, which is a financial asset. And that's that. Thank you, Latif. Absolutely correct. Who is going to go for B? Let me try some.
Let me go for B.
Okay, Joseph, go ahead, please. Joseph, go ahead. Joseph.
Okay, sir. B says net worth owns a demand deposit of 1 million naira with a First Bank. This is it's a liability, financial liability. Like you define that a financial liability is the obligation to deliver cash. Hello, sir.
Okay, I'm with you. Go ahead.
I said it's what that exists here is financial liability.
Okay, so you are saying
Because
network has a financial liability?
yes, sir. Has a financial liability with First Bank.
Okay.
Like you define that financial liability is the obligation to deliver cash.
Okay, no problem. So, I think Latif is raising his hand. He wants to say something. Go ahead, Latif.
Okay.
Okay, thank you, sir. The question says net worth owns a demand deposit of 1 million with First Bank. So this one, there are two parties. It means that there is a financial instrument. And something is that net worth that has 1 million in First Bank has a financial asset, while First Bank that keeps the money for network has a financial liability. We deliver 1 million naira to network.
Thank you very much, Latif, again. And that's absolutely correct. That's absolutely correct. So net worth owns a demand deposit of 1 million. That's a financial asset because net worth has a right to receive cash. Demand deposit is just like fixed deposits. It's just like you keep your money in the bank for a few days and you can collect it anytime and they must give you. And First Bank here has a financial liability. Even though our focus is with net worth has a financial asset. But First Bank has a financial liability because they have an obligation to deliver cash. And they must deliver it whenever net worth needs its money. And because also these two parties are present, one party having a financial asset, another party having a financial liability, then a financial instrument exists. Thank you, Latif. Who is going to go for C?
Let me try, sir.
Okay, go ahead, Femi.
Okay. Net worth statement of financial position include 2.5 million shares of Google Incorporation. Now, this one is equity instrument. That net worth has an equity instrument with Google International, and like it's like an asset to net worth now in his statement of financial position, which he is going to retrieve, and there is contract between them too, and he's going to retrieve a return on his investment. I don't know if I'm okay, sir. I'm correct.
You have not answered the question.
Oh,
What
okay.
does net worth have? Does net worth have a financial liability, a financial asset, or equity?
Okay, it has a equity instrument.
Okay, no
Yeah,
problem. What about Google?
yeah. Google now has a liability. Is it liability? No, like a financial instrument. That is a like a instrument as like a loan.
Okay, so no problem. Thank you, Femi. Any comment on that from anyone?
Okay, yes, sir.
Okay,
Let
Joy.
me talk more on that.
Okay.
Net worth has a financial asset, while Google International Incorporated has a financial liability. Network owns a 2.5 shares with Google International. So it's Google International that sold the shares to Network. So to Network is a financial asset, while to Google Incorporated is a financial liability.
Thank you, Joy. Again, any further comments on that from any other person? Okay, Elozo, go ahead.
All right. I think it's not financial liability, rather it's an equity instrument.
Okay, so that's correct. That's the answer.
So there's no liability.
Okay, thank you, Elozo. There is no liability here. It's actually an equity instrument. So the answer is this. So Joy, you tried, but the other leg was actually incorrect. Why Femi did not get any one of it right. So here, net worth bought shares in net worth, and that's a financial asset. I already explained that to you. That financial asset is an equity instrument of another entity. So you cannot say that net worth has an equity instrument. I mean, that's something else entirely. We expect you to say net worth has a financial asset. And Google has an equity instrument. I already explained this also, that when you issue share capital, that is equity instrument. It is when you issue debt instrument like commercial papers, loan, and all of that. That's when you would have a financial liability or debt instrument. But in this case, Google issued shares. So Google has an equity instrument. So it's important you're able to distinguish that, extremely important. So again, because the two parties are present, there is a party that has a financial asset, and there is another party that has an equity instrument. Therefore, a financial instrument exists. And that's it for that question. Who is going to go for D?
Let me go for D.
Okay. Go ahead.
New World Statement of Financial Position includes inventory of 56,000. In this scenario, there is no financial instrument because inventory, you generate cash. Cash is not being received or given. So there is no financial instrument.
Yes, that's correct. That's correct. So inventory is not a financial asset. So net worth here does not have a financial asset. We don't have any other party that has financial liability. So financial instrument does not exist here. So inventory is inventory in line with IAS 2. It is not a financial asset. So, Bosse, you're correct. Who's going to go for E? Who is going for E?
So let me go for E.
Okay, Joseph, go ahead.
A net worth sold the goods amounting to 55,000 to Lai Limited on credit. So in this transaction, financial instrument exists. Now, net worth has a financial asset why Lai has a liability with net worth.
Okay, thank you. That's correct. So net worth has a financial assets because he has a trade receivables. He sold on credit. And Lai has a financial liability because he has a trade payable. Because there is a party that has a financial assets and there is another party that has a financial liability. So we have the two sides complete. So a financial instrument exists. Okay, we'll go for the next one, F.
Okay. Good evening, sir. Let me try, sir.
Okay, go ahead, Michael.
On December 2021, Network received an advance payment of 250,000 naira from one of its customers, Mori Limited, to deliver goods in January 2022. So for me, this is a financial liability because there's a contractual obligation for Network to deliver the goods of 250,000 naira that he has collected money in advance, which is trade payable to Mori Limited. So it's a financial liability.
Okay, so next one has a financial liability. Okay, so does a financial instrument exist here? Is there another party that has
Yes,
financial
there's another party, Mori Limited.
that has what?
So that's having financial assets.
Okay, that's not right. Latif, go ahead.
I think we're on F, sir.
Sorry?
On December 2021, Network received an advance payment of 250,000 from one of its customers, Muri Limited, to deliver goods. So this is not a financial asset. To deliver goods is not a financial. There is no financial instrument, sir.
Okay, good. So what does network have here?
I will say maybe it has a financial liability, sir.
Okay, I think which is the same thing Michael mentioned. Yeah, I said it's wrong.
Because it is to deliver goods, I don't want to believe it is. It means to deliver cash. So there is no financial instrument, sir. I'm sorry. That's my position.
Okay, good. And your position is right now. Because he has, see here now, network received money in advance from Mori to deliver goods, right? He received money in advance to deliver goods. So net worth has something we call contract liability. You see, when you collect money from a customer to deliver goods, IFRS 15 says that that money you collected is not yet revenue for you because you have not delivered the goods.
Can you take that again?
I said IFRS 15 says that net worth has a contract liability. A contract liability. And this usually happens when an entity receives money from a customer and he hasn't delivered the goods and he hasn't or delivered the service. So in such cases, the money that entity has received, it cannot recognize such money as revenue. You cannot say that's revenue. It's just like us now, equity. Most of you have paid for your classes. We cannot recognize the money we have collected from you as revenue totally because we have not delivered the service. We are delivering the service gradually. So we cannot recognize the whole money you have paid that we have collected from you as revenue. That's IFRS 15. So what net worth has here is a contract liability, not a financial liability. And it is not a financial liability because the obligation is to deliver goods, not cash. That was why I said focus on this one first. When I was defining it, where is it? I said financial liability is a contractual obligation to deliver cash. You need to understand that very well. Very well. So if you understand that very well, then you will know that here is not a financial liability. When I teach you IFRS 15, you will talk more about, okay, when you collect money that you have not worked for, that's a liability to you, and we call it contract liability. And it's not a financial liability because the obligation you have in such cases is to deliver goods and not cash. So for you to have a financial liability, it has to be an obligation to deliver cash. So I think Latif was correct. And here, we don't have a financial instrument. Financial instrument does not exist here because the other party does not have a financial asset because what is expecting is goods, not cash also. So it's not a financial asset. There is no financial liability. Financial instrument does not exist. And that's the answer for this. Who can go for G? Oh yeah, Omolola, go for G. You are muted. Oh yeah, oh. Yeah,
Okay.
sure.
Good evening, sir. Good
Good
evening,
evening.
everyone. Okay, I'll go for G. Network statement of financial position include a current tax liability of 5,000 naira as well as a deferred tax liability of 6,500. Okay, I would say this is a sorry, sir, I don't really have idea of this one, but I have idea of the last one.
Okay, no problem. So let's reserve the last one for Molola. So who will take this one? Who is going to take G? Okay, Elozo, go ahead, please.
I think there is no contract here because the second party was not mentioned. Yes, it is tax, but we don't have a second party.
The
We are
government.
just having.
They don't need to mention the second party. In the cases of tax, it's the government. So I've mentioned it for you. Yeah, answer it.
Okay. If that is the case, that means there is a contract because government can penalize those who fail to pay taxes. So there is a tax, there is a financial asset and as well financial liability.
Okay.
Financial asset to the part of government because they are receiving cash, but the net worth it's having a financial liability to pay this cash.
Okay, that's very rational from you. That's a good well. But the way you should see it is this. There is no financial liability, there is no financial asset because there is no contract. When it comes to taxes, there is no agreement between you and the government. There is no contract between you and the government. A tax is a compulsory levy. Government is not agreeing anything with you. It's not, you don't have a choice. Just, you have to pay. Yes, they will penalize you. It's not a contract. You don't have a contract with the government. It's not an agreement. It's compulsory. Go and pay. As soon as you're an organization that makes profits or you're an individual that earns income, pay. So for that reason, tax liability are not financial liability from the standpoint of the taxpayer. They are just tax liability in line with IAS 12. So I'll be teaching you IAS 12 in a few weeks' time. So tax liability is tax liability, not a financial liability, simply because of that contract thing. Yes, there's an obligation to deliver cash, and the government has a right to receive cash, but there is no contract there. There's no contractual. So, and that's the solution. There is no financial instrument here. But you tried. At least you should
Hello,
someone.
sir. Hello, sir.
Yes, Latif.
Well, tax is a social contract now. Paying tax is a social contract between the citizen and the government.
Yes. So social contract is just a terminology used to describe a sense of commitment and responsibility that a government has to its citizens to provide social amenities. Is like saying that the government has promised that you're going to take care of the people when you get into power. That's social contract. It's different from business contract. What we are talking about here is not social contract, but business contract. I hope that cleared that.
Thank you, sir.
Yeah, you're welcome. Molola,
Yes, sir. So
okay.
I'll go for H. Network purchased a Bitcoin of five, um, 5.5 million. In this situation, I would say it's a financial asset because the number one, I would say is a financial asset does not have a financial liability, like because there's no person that is selling to or that is buying. He's the
How
one
long
that
have
bought.
So who did they buy it from?
He bought it for the company, like, because it said he purchased a Bitcoin, which has the potential for future growth.
And you will have bought it from somebody now.
But it was not stated, sir.
Yeah, they don't have to state it. You should know that they can be quiet about that. But there's another party that actually exists.
Okay, sir.
So, Omoyola, you're saying that Bitcoin is a financial asset, right?
Yes, sir.
Okay. And from if I get you right, also there is a financial instrument that exists. Okay. That's logical, looking at the way you're looking at it. But no, Bitcoin is not a financial asset. It doesn't meet the explanation I'm giving you as financial asset. Everybody here should know what Bitcoin is, a cryptocurrency, a digital currency. It's quite gaining momentum all over the world, but it is not a financial asset. I told you that financial asset is cash or equity instrument of another entity or a contractual right to receive cash. Bitcoin is not cash. Yes, some people accept it as a medium of exchange. That's some people, right? For an item to be called cash, IS 7 define cash. IS 7 on statement of cash flows. IS 7 says that cash is a medium of exchange that is generally acceptable. Bitcoin is not generally acceptable, so it's not cash. Furthermore, IS 7 also said that cash must have an insignificant risk of changes in value. So cash is not something that fluctuates in valuation. It has to be stable to a very large extent. Bitcoin is highly flexible in terms of value. And of course, those that actually exposed to that ecosystem would understand that the value is highly volatile in terms of the variation in its valuation. It could be $10,000 today, and tomorrow they are saying it's $15,000. That's a huge volatility. So Bitcoin is not cash. Bitcoin is not shares. I mean, it's far from it. Bitcoin does not give you right to receive cash. No. If you buy Bitcoin, if you need back your money, you need to find the seller to sell it to. You need to sell it to the exchange where you bought it from. So it doesn't meet any of those elements of a financial asset. So clearly not a financial asset. So for that reason, the counterparty, the exchange that you must have bought the Bitcoin from does not have a financial liability. So financial instrument does not exist here. That's the answer for this. Network does not have a financial asset and financial instrument does not exist. Okay, that's the solution to this. Any question before we move to another question? I want to change my internet to another one. I know this is good, but I just want to change to a Wi-Fi network. Okay. Can you please confirm that you can hear me before I move on?
We can hear you.
Yeah, we can.
Okay. So I think I'll move to another question. But before we move to another question, there's a question you're supposed to ask that nobody's asking. That means you know it. So let me just ask you. So since we are not classifying these as a financial assets, then how do we then classify Bitcoin? What is it? How do you classify it in our books? Elozo, yeah, go ahead, please.
It's a digital asset.
It's a digital asset. Okay, yeah, that's correct, but we don't have that kind of class of assets in accounting yet. So
So
you need
to
to,
me,
yeah, Joy, go ahead, please.
I'll classify it as an inventory
Okay, yeah, inventory. Why?
because
Why would you
I
classify?
it's what I can use to make money. If I sell it, I will make cash.
Okay, I think I would agree with you if that's your reason. So you can classify it as inventory if not because you can use it to make money, but because if you are holding it with the intention of reselling, if your own business, if your primary line of business is reselling these Bitcoin to other people that want to buy it, then fine, is an inventory for you. So that's correct. So Latif, you were also raising your hand.
Yes, I think I've heard it before that it is an intangible asset.
Yeah, that's also correct. It meets the definition of an intangible asset that I gave you. So the person that said it digital asset. So based on current classification and reporting right now, digital assets are actually intangible assets. So if you had mentioned that is an intangible asset, I would have said you are correct, and I've taught you that already. So most softwares, most this Bitcoin and all of that can also fall as an intangible asset because they don't have physical substance. It's not something you see, and you make money from them as it were. Okay, let's solve another question. So this is also another past question. This is also another past question. Okay. Femi, you're needed again.
Okay, sir. Okay, question 14. Aqua
1.5.
Nigeria Limited is a private limited company planning to be registered with the Nigerian Exchange Limited, NGX. The company is engaged in the conversion of petrol engine into compressed gas engine. The following are the transactions of the company in respect of its debts and equity instruments. Transaction 1. Aqua Nigeria Limited issue 40 million non-redeemable 1 naira preference share at par value under the term relating to the preference share. A dividend is payable on the preference share only if Aqua Nigeria Limited also pay a dividend on its ordinary share for the same period. Transaction 2. Aqua Nigeria Limited enter into a contract with supplier to buy a significant item of equipment. Under the term of the agreement, the supplier will receive ordinary share with an equivalent value of 5 million naira 1 year after the equipment is delivered. Transaction 3. The directors of Aqua Nigeria Limited, on becoming director, are required to invest a fixed agreed sum of money in a special class of 1 naira ordinary share that only director holds. Dividend payments on the share are discretionary and are ratified at the annual general meeting AGM of the company. When a director's service contract expires, Aqua Nigeria Limited is required to repurchase the share at their nominal value. A senior accountant in your company, Aqua Nigeria Limited, has asked for your advice on how the above transaction should be treated in the financial statement of your company in accordance with IAS 32 financial instrument presentation. Write a memo on the above request, discussing and justifying how each of the transactions should be treated in the financial statement in accordance with IAS 32 financial instrument presentation.
Thank you very much, Femi. So if you look at the requirement of this question, we are asked to write a memo on the above requests, discussing and justifying how each of the transactions should be treated in the financial statements in accordance with IAS 32 financial instruments presentation. So when the examiner says write a memo, please give them a memo. Please. I mean, because it's like a free point for you. And for a memo, the structure is quite straightforward. Let me put the solution here. So all you need to do is to put from, let's assume, they say a senior accountant in your company has asked for your advice on how, so let's say it's coming from you. Let's say you are it's a junior accountant to, let's say this, to the senior accountant. Let's say you are the senior accountant. Let's put the date. So July 27. Let's put the subject, accounting treatment of transactions. Okay, so let's say I write to you in respect of the subject matter. The following paragraphs explains the treatment of the given transactions using IAS 32 financial instruments presentation as a guide. Okay, then you start. You do, I think they give us 3 transactions. You do with transaction 1, you write what you want to write, you do transaction 2, you explain the treatment, you do transaction 3, you explain the treatment, then you do conclusion. You can say from the treatment above. I hope I have clarified the treatment of the given transaction. If you require further clarifications, please do not hesitate to reach out to me. Thank you. All of us you content, you can sign here. Okay, this is a template the examiner is expecting from you. Then it's important you're able to follow this. Then let's read each of these transactions. Then we would explain how they operate. So we are talking about Aqua Nigeria Limited, who is a private company and is planning to be registered with the Nigeria Exchange Limited. The company is engaged in the conversion of petrol engine into compressed gas engine. The following are transactions of the company in respect of its debts and equity instruments. So transaction 1, we're told here that Aqua Nigeria Limited issued 40 million non-redeemable 1 naira preference shares at par value. Under the terms relating to the preference shares, a dividend is payable on the preference shares only if Aqua Nigeria Limited also pays dividend on its ordinary shares for 5 marks. Okay, so how do we treat this? So let me answer this for you. Then I would allow you guys to speak on this other 2. So the way I would have answered this one is this. I will think through it, right? That this company in question issued 40 million non-redeemable preference shares. Ordinarily, without even thinking twice, he has issued shares. So that should be an equity instrument in the books of Aqua Nigeria Limited because he has issued shares. But when I look closer, I saw that this is a preference shares. Well, yes, even if it's a preference shares, that does not stop it from being an equity instrument. And also, it is a non-redeemable preference shares, which also shows that the company is not paying back this money. They are not paying back. So, which also goes to show that, yes, it's an equity instrument. Because for equity instrument, we don't expect to pay back to the investor. So, non-redeemable preference shares shows that it should be an equity instrument. However, we're told from here that under the terms relating to the preference shares, a dividend is payable on the preference shares only if Aqua Nigeria Limited also pays dividend on its ordinary shares. This shows that since dividends are paid to preference shares only when dividend is paid to ordinary shares. This also further shows that this is an equity instrument because dividend is paid only when the company decides to pay dividend to ordinary shares. Dividend is not, so the company does not have an obligation to pay dividend. They only pay dividend when they are paying their ordinary shareholders dividend. So this also shows that it is an ordinary shares, and it's an equity instrument. So number one, I will tell the examiner that the preference shares that was issued by ICAN Nigeria Limited is a non-redeemable preference shares, which means that the company will not collect or receive back its money, will not pay back the money or investments to the holder or to the shareholder. This indicates that the instrument is an equity instrument because equity instruments you don't pay back. Additionally, we're told that dividends are paid to the preference shareholders only when the ordinary shareholders, only when the ordinary shareholders are paid dividend. This also shows that the company does not have. Can I please finish? Or is so urgent?
Look at after additionally. Look at that. After additional.
Okay, we inform that. Okay, thank you. Okay, this also shows that the company does not have an obligation to deliver cash. Hence, it further strengthens our position that this instrument is an equity instrument. ICAN Nigeria Limited, since I've mentioned it before, I'll say the entity should treat the non-redeemable preference shares as an equity instrument. You can stop here, okay? If you are good with double entry, you will say this is recognized by debiting bank and crediting equity instrument. So that's the solution to one. Let me bring this down. And I hope this is clear to every one of you. So let's move to the transaction 2. Transaction 2 says that ICAN Nigeria Limited entered into a contract with a supplier to buy a significant item of equipment under the terms of the agreement, the supplier will receive ordinary shares with an equivalent value of 5 million 1 year after the equipment is delivered. So let me allow you guys to also contribute. How will Orca Limited treat this one? If I want to just give you one or two of you to contribute to this conversation. Okay, nobody. Who do
Hello,
everybody
sir.
is? Yes, Latif.
Aqua Nigeria Limited enter into a contract with a supplier to buy a significant realm of it. So under the terms of the agreement, the supplier will receive ordinary share with an equivalent value of 5 million 1 year after the equipment is delivered. Will receive ordinary shares. Therefore, it means that that supplier will have a financial asset. If ordinary shares, it means that it has ordinary shares in Orca Limited. So that's a financial asset to the supplier.
Who is
Then on
talking
the
about
part,
supplier? Latif, who
sir,
is talking about supplier? You are talking about Orca Limited.
let me come again, sir.
Yeah, come again.
Orca Nigeria Limited entered into a contract. It has a contract with a supplier, okay, to buy, okay, to buy similar item of equipment. Under the term of the agreement, the supplier received ordinary shares. Sir, it means that there is a financial instrument between Orca Nigeria Limited
Yes, I think I agree with that.
and the
I agree.
supplier as well.
Yes, you're correct. But what does Orca has? That's what is it financial liability? Is it
They are an
financial?
equity instrument, sir.
Equity instrument.
Okay. So,
But I think it will be discounted to today since it's going to be a 1 year.
okay, okay. We are getting there. So, Lukman said equity instrument and we are discounting that 5 million. Okay, we are getting there. Elozo, you raised up your hand. Let me hear from you.
I wanted to say we have a financial liability from the part of Aqua Limited. Then the supplier has equity instrument upon supply of that ordinary 5 million watt ordinary share.
How does Orca has a financial liability? How does Orca have financial liability?
He has that liability to transfer because that ordinary share that he is to give out, it's a way of giving out resources of the company,
So when you are
which can
issuing
be
yes.
converted to cash.
So when you issue shares, so that's liability. When you issue share capital, is that not share capital in your books?
No, sir.
Which equity instrument?
Yeah, Latif, you're going to say something?
The supplier will have a financial asset, while
Okay, well,
the Oka will have equity instruments.
okay, no problem. That's you guys are getting there. Yeah, it's so nice that some of you are actually thinking through this. So if you look at it on the surface, looking at it the way it's written and what I've taught you so far, you'll have been right, especially the last speaker, that Oka Nigeria entered a contract to supply with a supplier to buy plants. That okay, oh, I want to buy plant from you. So the agreement says that okay, that the supplier will get shares with an equivalent value of 5 million 1 year after the equipment is delivered, which means that then that yes, I will give you those equipment, Oka will get the equipment, and I'm agreeing that yes, you give me shares. So in the books of Oka, Oka now has a PP. He has an asset, not financial asset, to PP, and a property, plant, and equipment, so which he will debit. That's not where we are going. Then in this case now, he's not paying with cash. He's not paying money. He's paying with shares. He's paying with his equity instrument, with his ordinary shares, because that's what the supplier has agreed to receive. So are you going to then credit ordinary shares? Ordinarily, that is what we should credit, because he's issuing shares. Clearly, that's share capital, that's equity instrument, clearly. But there's one thing they now mentioned here. They say that these ordinary shares would have an equivalent value of 5 million. Would have an equivalent value of 5 million 1 year after the equipment is delivered. Which goes to show that this guy, yes, is issuing shares, but he cannot say for sure now, today, that we want to enter this transaction in our books, that this is the number of shares I will issue. He doesn't know. So if you don't know the number of shares you are issuing, you cannot credit share capital. It's not possible. When you want to increase your share capital, it's not about increasing. You see, when you increase share capital, you increase it with nominal value, with the nominal value of that share capital. And knowing the number of shares is important, because the number of shares we will issue can only be determined in the future. And the number of shares would, of course, be dependent on our share price in the future. Since they say that the value of the shares will be 5 million. Yes, it will be 5 million, but the number of shares we will issue is variable. It's not something that is fixed. We don't know. It depends on what our share price would be in that 1 year time. If our share price is 10 naira in that 1 year time, that means we will issue 500,000 shares. If our share price is 15 naira, that means we issue 100,000. I mean, it's variable. For that reason, when the number of shares we will issue is variable, when we cannot determine the number of shares we are issuing now, you cannot credit you cannot credit equity instruments with that. That is not an equity increment, even though the instrument you are issuing is shares, is ordinary shares. By default, that is share capital. You should credit share capital. But S32 here is saying that where the number of shares is variable, there is an element of uncertainty there. There's an element of obligation there in that wise. Because we don't know, we cannot credit share capital. And when you cannot credit share capital, it has to be financial liability. And that's the only reason. There is no other reason. Because here we are not delivering cash. It's not cash we are delivering. We are delivering another financial asset. Though I taught you that financial liability is a contractual obligation to deliver cash or another financial asset. Yeah. So in this case, there is an obligation to deliver another financial asset. And for this one to work, it means that that financial asset we are delivering has, if it's shares, it has to be a variable number of shares. So you need to add that to your dictionary. So the way this will work is this. ICAN Nigeria Limited will debit or will recognize the equipment as property, plant and equipment in line with IS 16, but the mode of settlement is through the company shares. Ordinarily, where an entity issues ordinary shares, this should be treated as an equity instrument. IS 32 states that where the issue of shares, the issue of ordinary shares is a variable number of ordinary shares the share issue will be treated as a financial liability. So the entity will treat the share issue as a financial liability by debiting the equipment and crediting financial liability. Additionally, the settlement will occur in 1 year time. Therefore, we have to discount the 5 million to its present value. It is the present value that will be recognized in the books. Okay, that's transaction. That's transaction 2. So thanks to those of you that contributed. I'm sure you have gained one knowledge or the other. Finally, for today is transaction 3. This says that, Elozo, yeah, can see your hand. Please go ahead.
Does it really mean that in this case we have two financial? Can you hear me, sir?
Yes, please.
So does it mean that Aqua and this supplier both have financial liability?
No. The supplier does not have a financial liability now. The supplier is expecting shares. So he will have a financial asset. He has a contractual right to receive another financial asset. Not cash, but another financial asset, which is shares. So I didn't just mention him because my focus is on Orca. How Orca will treat this in his books. But the supplier has a financial asset, while Orca has a financial liability. Is that clear?
Yes, sir. Thank you, sir.
Okay.
Sir,
Yes, Femi.
sir, what would have made the difference? Suppose we are given the share value.
No, they were given the share value now. Or do you mean suppose we're given the number of shares?
Number of shares, sorry, sir. Yes, sir.
Yeah, so it's an equity instrument to Orca. Instead of financial liability, is an equity. If they didn't say what makes it financial liability is the fact that they said it should have an equivalent value of 5 million in 1 year time. So that means the number of shares is variable. So when we are issuing a variable number of shares, IS 32 says that that's a financial liability.
Okay, thank you, sir.
You're welcome. Now let's look at transaction 3. This states that the directors of Orca Nigeria Limited, on becoming director, are required to invest in a fixed agreed sum of money in a special class of 1 naira ordinary shares that only directors hold. Dividend payments on the shares are discretionary and are ratified at the annual general meeting of the company. When a director's service contract expires, Orca Nigeria Limited is required to repurchase the shares at their nominal value. Okay, so the scenario here is this. Anytime we have a new director, so those directors are required to buy a special class of ordinary shares for a fixed agreed sum. So Orca will issue them a fixed number of shares. They will issue them not even a fixed number of shares. They will issue shares to them based on that fixed agreed sum. Then dividend payments on the shares are discretionary and are ratified at AGM. And when directors' contract expires, Orca Limited is required to repurchase those shares at their nominal value. So this is similar to the last one. So as far as Orca is concerned, I'm not focused on the director here. What I can say is this. Orca will issue a special class of shares. Whether a special class or not, it does not even affect my accounting. Orca will issue shares to the director, to any new director. That's one. Secondly, Dividend is not compulsory. So Onka does not have an obligation to deliver cash here because dividend payments are discretionary and are ratified at AGM. So it's not compulsory that we have to pay dividend. Thirdly, when directors' contract expires, Orca is required to repurchase the shares at their nominal value. So ultimately, whenever directors' contract expires, meaning when they cease to become a director, when they cease to becoming a director, the company would buy the shares from them, meaning that the company will give them money. That, okay, take back your money, give me back my shares. Okay? So, I mean, a lot of things going on here. But from this analysis, I can see that the end result of everything ends, which is, of course, in future, it ends in a scenario where Orca would have to buy the shares back from them, where Orca would have to repurchase the shares. Ultimately, you would have to deliver cash. So clearly, Orca has an obligation to deliver cash because he has to buy those shares back from the director. Because of that shares that Orca issues to the director will be treated as a financial liability. To be treated as a financial liability because of that. So, the ordinary shares issued to the directors seems to be a variable number of shares because the directors are required to pay a fixed sum. So the shares that will be issued, that will be ultimately issued, will vary because the share price will not be constant anyways. Furthermore, the dividend payments are discretionary. This indicates that, or this shows that the company has no obligation to deliver cash. However, the company or the entity is required to repurchase the shares from the directors, indicating that the entity has an obligation to deliver cash to the directors when they cease or when their contract expires. Following from the above, the ordinary shares issued to the new directors be treated as a financial liability by debiting bank because the directors will pay and crediting share. Okay, and that's the solution to this. Of course, I'll share this working note with you, and you would be able to see the solutions there. Now, this one is your assignment. Of course, for those of you that have not been doing assignments, I don't know how you would cope in this class, but I mean, it's important you do your assignment so that you would your passing this diet will be very certain if you are following and doing my assignment on time. I'll stop here for tonight. Our time is actually up. It is 9 o'clock. I'll see you guys next week. I can't promise that we'll finish this topic next week, but I know that we're going to go far. That even if we don't finish it, it will just remain maybe an hour class for us to finish and move to another topic. So ordinarily, I'm supposed to start group accounts next week, but I'm going to move it to September so that I can teach the very important standards. Standards are very, very important at your level. So I will just move group accounts a little forward and focus on more standards like IAS 36, IFRS 16, and IFRS 15 on revenue. Yeah. And maybe IFRS 13. I saw that in your syllabus. I mean, I don't know why they are putting that there. But I'll probably take IAS 21 as well on effect after the effect of changes in foreign exchange rate. Those I want to take off those key standards early enough, even provisions, all of those ones. I need to take off those standards so that when I'm starting group accounts, what I will have left will just be statement of cash flows, then sustainability reporting framework, and maybe IT in financial reporting and ratios. So just those ones are what I want to take much later. Those ones are very straightforward. But all these standards, I want to take them off early in the standards. So we're going to be battling with those ones in August. That's our mission for August, to take off those key standards. So while in class, I shared the past questions, the collated past questions from 2014 to 2014 to 2024. And I want you to start solving any questions you can find on any topic you have done. You need to solve all of these past questions, all of it. Then if you do that for financial reporting and your other courses, it's not possible for you to fail now. It's not possible at all. Okay. Any comments before we go for today?
Sir, if you can please share the question bank again. I don't have it.
I just shared it tonight, so I
Okay.
guess we should look at it again.
Okay, sir.
Yeah. All right. Bye. See you on Saturday. Have a wonderful week. Bye.
Thank you very much. Bye.